Good evening. It's Thursday, November 4th, 7:09 p.m. Good evening to you, Wowie.
Good evening, Mark.
And good evening to our listeners. Happy Thursday evening. I hope everyone had a great week so far. Welcome to episode 23, Fire and Ice. This is your host, Mark Yu.
And Wawi Santos.
And welcome to the Mark Yu and Wowie Show. Disclosure, this show is made for sharing purposes only and not to be considered investment advice. We record once a week. I and Wawi are both physical therapists here in the USA with the same passion and interest in researching and investing our hard-earned money in the stock market. This show's goal is to share and learn from each other and answer questions. To our co-workers in the medical field, thank you guys for your hard work. We are available in YouTube, Spotify, and Google Podcasts. In our previous episode, episode 22, we discussed the stock market sentiments and industry performance, the fund flows, the big tech earnings, Facebook, Google, Tesla, Apple, Amazon, and Snap, all in one episode. In addition, we also discussed the strength and the slowdown of the GDP, US GDP, and the cooling real estate market. We also had the Roll the Clips segment with Mike Wilson, Morgan Stanley's Mike Wilson, and Fundstrat's Tom Lee. If you want to hear more about the Fire and Ice segment, please stay tuned. So for today's topics, we have the following. These are just fresh from the oven. Press releases, earnings, quarter earnings by Uber, Airbnb, and Peloton. And we're going to take a look for the first time, the immediate stock price reaction of these companies, which we haven't done before. Followed by the very much awaited tapering announcement by the Fed yesterday, followed by the consumer sentiment and savings dip here in the US, and our weekly discussion about the sentiments of the stock market and the flows. And we're gonna add today special part of our episode today is the options activity, followed by Zillow's collapse, as I would say, because it just suffered a big dip in its stock price. And lastly, the Roll the Clip segment. We're going to have at least 3 interviews that we're going to discuss in a few. So for the first slide, so we're going to discuss Uber's first time ever recording an adjusted profit this quarter. Its sales are up 72%. Food delivery service and mobility ride sharing services. What do you think about this, Wawi?
Well, finally, that's good.
Yep. This first profitable quarter as adjusted EBITDA. So one thing about this adjusted EBITDA, it always reminds me of what Charlie Munger described this earnings. So Charlie Munger, for those who don't know, is one of the Warren Buffett's partner in Berkshire Hathaway. So he's deeply grounded in value investing, and he has clearly shared his thoughts against adjusted EBITDA. He called it bullshit earnings at one point because it's so much unreliable, and companies can definitely do their magic and produce a positive result in this metric. So nothing to take away from Uber. We're going to take a closer look at its filings that they just released this afternoon. So according to their CEO, Dara Khosrowshahi, said the company had seen driver supply steadily returning thanks to decisive investments in getting workers back on the platform during a period of nationwide labor shortages. So as you guys may have known, we are in an era of the Great Resignation. So people are easily going from job to other job, resigning and looking for better opportunities because of higher pay. So in this Financial Times report that was just published, Uber also reported a significant recovery in trips to and from airports, growing 20% from the beginning of September. Business trips on the platform were up 60%. So these are signs of big recovery in the US. So this is its filings that can be located in Seeking Alpha, a very reliable news center for publicly listed companies.
Once. Can they sustain profitability?
So gross bookings reach an all-time high. Wow. Uber reached an all-time high in its bookings, up more than double, 114% to $22 billion. So I would say this is not just BS earnings. So we're gonna look at so one of my favorites. So since it's obviously that the Uber is growing tremendously, we're gonna skip the income statement at this point in time, and we're just gonna look at its more defined revenue, where it gets most of its revenue. So mobility, obviously, they get a lot from that business segment. So 184% change, adding $5 billion. But look at this, delivery for Uber, it's even greater than its mobility ride sharing business. So people are still definitely ordering online and using Uber as a service, aside from its competitors DoorDash and Grubhub. So $12.9 billion in delivery, compared to mobility segment or ride sharing 8.6 billion. So Uber is definitely getting a lot of business from mobility, interestingly. And so we're going to skip on the balance sheet, which I usually prefer to look at just to see if the company is rock solid or if they're in cusp of bankruptcy. So since this is quarterly filing, it should be buried somewhere else. Oh, there. Deep within its filings, you can see here as of June 30. Sorry, excuse me. Cash cash and cash equivalents 4.4 billion. Short-term investments is 5 billion. So about 4.9 billion in cash. Add the restricted cash, 5.2 billion in cash. And now we're going to look at its debt. Long-term debt, 7.8 billion. And current liabilities, short-term reserves. So we would add this operating lease as well, about 200 million plus 7.8, about 8 billion. 8 billion in debt, 5.2 billion in cash. Not so bad, right? Equity, this is the book value of the company. Total assets minus total liabilities. This is the book value of the company, 14.2 billion. One thing to watch out for is if the total equity is negative, it means the company has very much leveraged balance sheet. So it's positive. So it's good. 5.2 billion in cash, 8 billion in debt. So not so bad for Uber. So its immediate price reaction is negative 0.93% or almost 1% down after market, which isn't bad. For the year, Uber is down 11.5% despite the reopening.
And we should expect it to improve further now that the service sector is more active,
right?
Because of the reopening. So expect more deliveries from Uber.
If people is gonna go ride, one thing that I would think of is in the near future, as the reopening play continues on, would the tide shift from delivery to mobility eventually? So will Uber get more business from mobility, or better yet, if they can still continue their growth in their delivery and also in much more in their mobility segment, then probably very much will reward the company in the end, because they're going to be able to develop more growth or find more growth in their business. So
yeah, what do
sorry.
you think about what happened with their stake with Didi in China? They had a loss in the quarter of 2.4 billion because of that stake with China-based ride-sharing company Didi. So did they take out their stake with Didi?
Right. So it says here in the report. That's a very good question, Wowie. I wasn't able to see that in the press release. It says here, including 272, net income benefited from unrealized gains of 1.4 billion and 471 million due to the revaluation of Uber equities investment in Didi and Aurora. Unrealized gains.
Okay.
I think they actually gained. So right now the the accounting, the GAAP, the generalized accounting principles, requires companies that have stock investments or equity investments in other publicly listed companies to announce what they've gained or unrealized. Even though they haven't sold their stake, they need to report how much they gained in that investment. So it says here unrealized gains. So benefited from its profit. Uber's bottom line
That's
benefited
good.
from unrealized gains of 1.4 billion due to the revaluation of Uber equity investments in Didi. So 1.4 they gained 1.4 billion in unrealized gains from Didi. So Didi probably has bounced back up. If you're able, let's see how much Didi stock right now. I think it fallen less than $10 at one point, right? $7 when they were trying to get it out. Oh, $8. It's still at $8 a share as of close this afternoon. So it's still below IPO. I think it was IPO at $14 or $13. So we're gonna jump on to the next Airbnb. So Airbnb, according to Seeking Alpha, which just published a couple of hours ago, Airbnb sees big surge in home rentals as vacation travel picks up. This is really good news for those who are who are invested in the travel sector, in the airlines, in the whichever sector.
Nice.
Reopening place. So Airbnb on Thursday today reported its best ever business quarter as revenue climbed 70% as people secured rental homes and took vacations that had been postponed. So Uber just reported its best ever quarter. Airbnb just reported its best ever business quarter as well, which is astounding. So, we probably already anticipated this as the economy is slowly opening, but still to read this fact from a news report is definitely an uplifting feeling. So Airbnb said that for its third quarter, okay, it earned 1.22 in revenue. So we're gonna look at its press release in a little bit, including its balance sheet. So according to its shareholder letter, Airbnb said, quote unquote, the travel rebound that began earlier this year accelerated. The world is undergoing a revolution in how we live and work. Gross booking value increased 48% from last year to today's to 11.9 billion. I'm interested looking at Uber's gross booking. Give me just a second. So Uber has nearly 22 billion. So definitely a different type of business. But yeah, for Airbnb, 12 billion for its rental vacation hotels or lodging, home lodging primarily. So this is the Airbnb's filing. Nights and experiences booked of 79.7 million represented a significant increase from a year ago, 30%. So the main reason I pulled this report up is I want to see their balance sheet. So it's already given. They have good revenue, best in record. So we're just going to look at its balance sheet.
Well, as of November 2nd, their market cap is $108 billion.
108 already? Oh my gosh. Can you check the Marriott's, Huawei, if you don't mind? Let's see how big is Marriott's, because they're kind of like competing with each other, some sort, with the vacation venues.
Okay,
or
let's see if
lodging
I can.
stays.
I'll go ahead and pull that up.
Yeah. So we're looking at that Huawei balance sheet items for Airbnb as of September 30. Cash and cash equivalents and marketable securities. Airbnb has about almost $7 billion. Wow. That's 8 billion. Correct me. I want to correct that. $8 billion in cash. And for its debt, let's see, funds payable, long-term debt, 1.9. Wow. They're cash rich. They're in a good position. 2 point something billion dollars in debt with $8 billion in cash. Wow. So Airbnb is definitely in a good cash position at this point in time.
Marriott is larger. What did I say?
108.
Airbnb.
108?
108. Oh, okay. So Marriott is 54 billion. Marriott is 54 billion market cap.
What? So Airbnb is double Marriott
Whoa.
capital. Oh my gosh! Wow. So as a result of its report, Airbnb is up 1.15% after hours. We could see probably some surge tomorrow. We're not sure if it beats expectation. Definitely, Wall Street likes that. So that's a good sign, though, overall. So we had a couple of very nice reports from Reopening Place. Now, this is the stay at home play, Peloton or Peloton Interactive. This article was just published a couple of hours ago as well. Peloton Interactive craters after full year revenue guidance fall well below expectations. So Peloton, as some people may not be familiar, it sells treadmills and other equipments um, to interested buyers for them to use at home. Obviously, it's not just treadmills. It has internet connection, which you could subscribe to, which forms another part of their business in order for you to stay active and be well engaged with other people. So it says in the title alone, the main reason why Peloton is dropping like a hot potato. So let's see what its stock is doing at this point in time. So Peloton is down 30%. Market close after hours from $86 a share when it closed earlier down to $60, and it's still moving. But right now it kind of plateaued at 30.16% down. So according to this article, Peloton actually still reported larger than anticipated loss. Okay. So it's all negative on this part because they reported larger than anticipated loss and they lowered their full year guidance. So
I wonder if it can recover.
It could, maybe. So it says here, Peloton sees full year revenue. So this is the main reason why the stock fell. Peloton sees full year revenue of 4.4 billion to 4.8 billion compared to a prior view of 5.4 billion dollars. They themselves announced the 5.4 billion, and Wall Street also sees or projects 5.4 billion, but they revised it at least a billion less to 4.4 billion. So more likely this is why their stock is dropping. Too much expectation. Quote unquote, according to company, their strategy update, we remain convinced that the growth opportunity for Peloton is substantial, and this informs our decision to prioritize accessibility and household acquisition over near-term profitability, particularly as our industry-leading net promoter scores and retention rates support a very strong consumer lifetime value and unit economics. So
yeah, with this subscription economics, it may recover. But people are eager to go back to the gym. On the other hand, we see a big price improvement on Planet Fitness.
Oh, right. Okay.
Today, because of that, that demand for going back into the gym.
That's perfect. How high is Planet Fitness today?
Let's see. I just saw it earlier this morning. Let's say Planet. Oh, Planet. There's so many different planets here.
We're doing this on the go, guys, so please stick with us. We're learning this as we're discussing it.
But, so, yeah. In comparison, right, we got a virtual reality type of workout on a treadmill or a bike. And now you're going into Planet Fitness. Planet Fitness, boom, 11%.
Oh, wow. Up 11% in a one day.
Up 11% today.
Wow, that's great.
Yes.
Good for Planet Fitness. I go there at least a couple times a week. Yeah, that's amazing. So definitely Reopening Place are back and they're going up. So
they're
Peloton,
going back to the gym.
Back to the gym, yeah. So Peloton, I'm just looking at their balance sheet. Cash and cash equivalents and marketable securities total about 1.5 billion. Let's see their debt. Senior notes, 830 million. Lease, 61. A little less than a billion. So the company is solid. They have about 1.5 billion in cash and about a billion in debt. And they have positive book value. So it's not that alarming that Peloton is trimming their projections, but definitely Wall Street was expecting a lot from them. So that's why their stock is cratering right now. So next topic, the finally anticipated the tapering. Here is an article from Financial Times. Jay Powell urges patient approach to rate rises as taper begins. Fed chair insists it is too early to countenance next stage of monetary tightening. Huh. So they're still not hiking the rates, but according to this article, let's see, quote unquote by Powell, it's appropriate to be patient, Powell said during a press conference 2-day meeting at which the central bank said it would scale back its bond buying program by 15 billion each month, a timeline that puts it on track to withdraw the stimulus entirely by the middle of next year. So by June next year, okay, the stimulus will be, the stimmy money will be back to zero. So the life support is slowly being removed at this point of time. The Fed, quote unquote, the Fed was sufficiently. Oh, so this is from Chief Global Market Strategist at Invesco, Christina Hooper, quote unquote, the Fed was sufficiently dovish, which markets always like. No one in the market was surprised today. So this was yesterday. So dovish meaning that the Fed is kind of like iffy and not wanting to hike the rates. There are two terms there are two lingo or Wall Street terms when the Fed is about to hike rates. One is hawkish, one is dovish. Dovish is like if the Fed is hesitating to hike rates, and hawkish if the Fed is wanting to hike the rates ASAP, or what has happened back in 2018 when Jay Powell just slowly ramp up the hike, and the market didn't like that back in 2018 December when the stock market started to fall during Christmas break and going to the new year. So Powell has learned that lesson hard. So probably that's why he's very kind of like how do you say, conservative in giving out any statements in terms of hiking rates. So let's see. Powell, quote unquote, we had the question on when to taper. We have now answered that question and the speed of it, which obviously is which we just discussed. 15 billion each month starting this month to middle of next year. So, but when it came to the matter of liftoff, so this is now in terms of hiking the rates for rate rises, Powell said the central bank was keeping its powder dry because it had not yet met the tests for next step of monetary tightening. Huh. The Fed has stipulated.
I like the way he set up the expectations for the market. At least we know now what the pace of tapering will be.
Right.
So this is good, right? So people are already pricing in the the taper, and so there's no tantrum.
There's no tantrum, yeah.
There's no tantrum. People are just like buying and buying the stock market right now,
right?
Because they know what to expect.
And we just closed third day straight all-time highs for S&P 500, I think Nasdaq.
Yes, it's amazing. It's unbelievable. But I think the factor for that would be Powell's ability to raise expectations and let people know what's going to happen. I think that's a very good strategy.
Yep.
So no one panicked. No one panicked.
No one did, yeah. So the Fed, according to this article, the Fed has stipulated that it will maintain interest rates at today's near zero levels until it achieves maximum employment and inflation averages 2% over time. So I think we've already achieved this for sure because we're at 4.2% at this point. But this one achieved maximum employment. So I think we're still 4 million underemployed, right?
I think so. I don't know the exact numbers, but that's what we haven't met yet. We haven't met that objective of getting people back to work.
Right. But the question, Wawi, I think in my mind is like, what if this is the new normal?
Yeah, I
And
think
what
it will
if
be.
the
I
other
think it's.
people?
I think it is. I think you're right. I think it may be the new normal.
Because people are quitting, right? The Great Resignation. People are resigning. It's not
Yeah,
like people can find work.
I said it's
Businesses
the
need
Great
workers.
Reset, but
Yeah.
you're right. It is specifically the Great Resignation. People are just
So,
reevaluating things. But what's gonna happen is people will realize that they're gonna need work.
mhm.
Uh,
Yeah, they can't just stay at home and do nothing or play
mm,
whatever.
no,
Um, so if that's the case, then maybe I don't know. Maybe we're near maximum employment, but who knows? Maybe J Pow knows better. Well, we'll
if
see.
you're a if you're a truck driver, you're doing good right now.
Oh, I heard that too. They're paying good. That's truck
Hmm.
driver. Okay. Here's a quote from serves as the head of global policy research at Cornerstone Macro, Roberto Perli, quote unquote. It is preferable to err on the side of caution because we know how to deal with inflation. We don't really know how to deal with too low inflation or worse, deflation. He added, they are doing the right thing. I guess he's referring to the Fed. So, yeah, Wall Street likes what Fed is doing.
Hmm.
So
I
here
like
is
it.
a, huh?
I like it.
I like it. And here's an article from CNBC. Traders move up expectations for the Fed's first rate hike to the summer of 2022. So obviously that's when the tapering ends, and the stimulus ends. So futures market moves slightly following. Okay, full rate hike. Previously, a full rate hike had not been priced in until the end of summer, according to Wells Fargo. So until end of next year, next summer, next year. But now it's moved closer to summer. The Fed said it would begin to taper back its bond. So okay, yeah, we've already discussed that. So on to our next. Okay, to be specific, the Federal Reserve said it will reduce Treasury purchases by 10 billion and mortgage-backed securities by 5 billion, marking the beginning of the end of the program aimed at shielding the economy from COVID-19. Officials decided to maintain the target for its benchmark policy rate. This is the current rate, 0 to 0.25%. Decision was unanimous. All right. So the Fed, in review, has been buying 80 billion of treasuries monthly and 40 billion of mortgage-backed securities every month to help stimulate economic activity that was crushed in the initial pandemic lockdown and subsequent uneven recovery. So 15 billion a month, folks. All right, on to our next segment. So this is something that we always keep an eye on, the consumer sentiment. This is an article by Watch published October 29th, entitled U.S. Consumer Sentiment Remains Near Pandemic Lows as Inflation Expectations Hit 13-Year High. So sentiment is definitely down, and along with it, the inflation uncertainty is higher today than in nearly 40 years. So the University of Michigan gauge of consumer sentiment rebounded slightly to 71.7%, below September, 72.8%. So what did the surveyor said? "Quote unquote, the positive impact of higher income expectations and the receding coronavirus has been offset by higher rates of inflation and falling confidence in government economic policy." Chief economist at the University of Michigan, Richard Curtin, quote unquote, consumers not only anticipated the highest year ahead inflation rate since 2008, consumers also expressed greater uncertainty about the year ahead inflation rate than any time in nearly 40 years. Note that this was the first major spike in inflation uncertainty recorded outside the recession. All right, so definitely a lot of uncertainty in our consumers' end and declining sentiment. So as a result, look here. This is another article from Market Watch on the same day. US consumers dipped into savings to keep spending in September. Savings rate falls slightly below its pre-pandemic level. So despite consumer uncertainty and 40-year high inflation expectation, consumers still spent money. Now that we don't have any stimulus coming from the government, no more freebies or free checks or steamy checks is what they call it. US consumers still kept on spending, which is a good sign. And now savings rate fell below its pre-pandemic level. So long before, I think we were hovering at 13, 16%. And now we're down to 7.5%, slightly below the pre-pandemic level. So this is something to watch out for. If consumer keeps spending like this, they will definitely start using credit cards and dipping into more into their savings, which would then propel further the U.S. economy, despite the dire sentiment that's happening.
You'll get the economic wheels rolling again.
Yes, definitely. And it would probably justify the ability of the government to pull out finally the stimmy checks so that people can be back on their feet and start spending on their own and finding work to at least maintain their level of spending. So now we're going to jump on our weekly segment, weekly sentiments and flows. So good thing we did this today, this evening, Thursday evening, Wowie, because
wow,
we initially looked at doing one yesterday when the Fed announced their tapering. So good thing we recorded this evening because AAII, or the American Association of Individual Investors, updates their survey once a week, every Thursday morning. So here is the AAII sentiment: bullish, neutral, bearish. So as of yesterday, people are getting more bullish. 41.5% are bullish compared to 39.8% last week. And people are getting less bearish, obviously. From 29.4, its bearishness is down to 26%. So people are getting more bullish. It's 3.5% higher than historical average. So fear and greed index. Currently, we are now in extreme greed in the stock market. Extreme greed, guys, 82 points. This compares to greed levels back last week, 72 points. So we jumped by 10 points. And if you're going to look at the graph, historical graph, we are now at the highest levels since late last year when the Pfizer and Moderna vaccine came out. So we are now at the bullish era. So volatility is down for the past week, 13%. So obviously the market has cherished what Jerome Powell has said about its plans of tapering. Well received, very dovish. Down 13 volatility, not much action in the market, but it just kept going higher, record highs. For the past 6 months, it's down 19%, almost 20%. For the past year, it's definitely down on the lowest side or low end, down 43%. So this is the one part of our sentiment and flow that we're going to add moving forward, the CBOE put call ratio. So put is the right to sell at a certain amount, certain date. Call is the right to buy. So in layman's terms, if this chart is high, it means investors are betting that the stock market will go down. If this ratio is low, it means that the investors is betting that the stock market will go up more. So right now, put call ratio is down. In terms of its average, it's still down. Oh, hold on. My dogs are inside the house.
My dog was opening my door too.
Max, go. Sorry.
They want to hear about the market.
Go outside, go. Sorry about that. For our 1 week performance, we are seeing that the consumer cyclical is outperforming the rest, while energy, the reopening plays, interestingly, is down. Energy or oil is down is the worst performer so far this week, down -2%, despite the strong earnings that's reflected by the tech or the reopening tech. I guess it's not getting carried over to the energy or oil. As I remember, I think oil was spiking really high, right? $80 a
Mm-hmm.
barrel.
Mm-hmm. Yeah, so I don't know what it is now. What I know is the oil rig numbers are going up.
Okay,
So we have a shortage on our inventory
right.
of our fossil fuel. So,
Mhm.
but they're ramping up drilling. So there's 15 more drilling rigs starting, totaling about 674 now.
Oh, we're at 600. Okay, long time ago, I think we were around 400, like really low levels when we
Mhm.
have a oil glut back last year when it was a lockdown. So
Yeah, they
this
were
is
hit.
uh
Yeah, they suffered a lot last year because of the lockdown. So, to mitigate their losses, they, slowed down their drilling or stopped it.
right.
But now, since our stockpile is low, they're ramping up production. So,
It's a cycle.
yeah, well,
Obviously.
we're not in the normal cycle
Mhm.
because, gas prices are going up here in Texas. Normally, gas prices will go down this time of the year. So that tells you a lot that we haven't caught up with the demand yet.
Right. There's so much demand and low supply, and with all the green energy,
Mm-hmm.
plans. So these companies, Exxon and Chevron and Shell, these big companies have pledged to reduce their carbon footprint. So overall, they can't just ramp up, or maybe they can, their oil production, or it might be just costly. So maybe we'll see how it plays out. Maybe there'll be higher oil price in the near future, unless Saudi starts pumping back more oil. I know for sure Russia is already making money hand over fist because they're definitely supplying a lot. Like their gas supplies and their storages are already like very low. They're giving everything to Europe because of the
Mm-hmm.
Nord Stream pipeline that they have access to now. So yeah, quite a geopolitical you know scenario
Yeah,
there. But we'll see
yeah,
how it goes.
yeah. Russia has a lot of leverage right now
For sure, yeah.
when it comes to trade, and
Mhm.
Saudi Arabia is ramping up production. Yeah, it's very interesting. Anyway, a lot of the oil companies are also selling some of their assets to
Mhm.
reduce their carbon footprint. So what you're gonna see are a lot of smaller oil companies getting into play.
Yeah,
So
that must be interesting to look at Pioneer, Diamondback, those companies. We need to probably take a closer look at them. But yeah, year to date though, wow, yeah, even though the energy is falling within the past week, energy, oil, these guys are the top performers among the bunch, even beating
mhm,
technology. They're up
mhm.
41%. So
Yeah,
cash flow. Oh, sorry.
yeah, you should see good price improvement with all these large oil companies, Exxon and Chevron next year.
hmm
So if any of our friends in the group are invested in oil, I think you guys have a good year to look forward to.
Right. And here's the cash flow, the flow that we track. This is from Barron's. They release this information once a week, every weekend. So cash track looks like more money has flown into equity or stocks. It says here cash infusions lifted the last month's average weekly inflow to equity or stocks to $7.6 billion. So definitely a spike there. So October definitely uh, was able the month this month investors were able to put more money into stocks compared to when it was in September when the stock market was quite in a downtrend that period. But yeah, the bounce from October definitely well supported by the flows. Mm, and now the cryptocurrency fear and greed. So Bitcoin Fear and Greed Index, currently we are at greed, 73 points compared to last week's 66 points. So it's still in an uptrend, not as bullish or not as greedy as the fear and greed in the stock market, believe it or not. So fear and greed in the
Mhm.
stock market is around 82 points. Not that these both graphs are related to each other, but in terms of point basis, definitely stock market is in extreme greed at this point in time. So this is the stock options that I saw somewhere in Twitter. Single stock options daily traded volumes were 1.4 times or 140% in October 2021, an all-time high on a monthly average basis. All-time high in options. So people
Mhm.
are doing options an all-time high at this point in time.
Mhm.
And that's the reason why we have included the put call sentiment in our sentiment segment. So this is an article, a timely article by Bloomberg, published a couple of days ago, entitled "Speculative Retail Option Traders Back in Droves." Sundial says money spent on speculative options bets near record. Activity can often precede mild, take note, mild pressure in equities. Maybe a little bit of correction. Stock option speculators are back trading in a big way, a sign of increased risk. Obviously, sentiment definitely is way up there. The fear and greed is up there. Obviously, stock options now trading at their all-time highs. People are feeling like they're in for a gamble, which we would see in our next slide. Uh, Very well supported. So bullish bets was in the top 2% of all weeks since the year 2000. So Geoffert wrote, quote unquote, money spent on speculative option trades is nearing a record. Risk just ticked higher for some higher risk parts of the stock market. So this is the chart. All right. That's what we've seen on the previous slide. So here, an article from the Forbes magazine published October 27. The Las Vegas Strip reports 2.1 billion in gambling revenue, highest quarterly win in history.
Wow.
So I guess gambling vibe or gambling fever is definitely in the air.
Well, I'll probably see how it's going over there because I'll be going there um, during the Thanksgiving week.
Oh yeah, that's cool.
Hmm.
We'll be
So we'll
there.
see.
We'll also be there a couple of weeks from now.
Well, we might see each other there,
Yeah.
and we can have our podcast together live.
We'll see. We'll see. Maybe
We'll see
maybe
what
live,
happens.
live in by the Bellagio fountains.
Yes.
Oh, it'll be an amazing treat. I mean, Las Vegas. Me and my girlfriend went there. I think April this year, and I can't get tired of it. I like to go revisit it back
Hmm.
because of its lights and everything. Lights and
Hmm.
glamour. It's everything. Lights and glamour. So yeah,
Hmm.
gambling is at all-time high in Las Vegas. If anything, that would indicate it would mean that people are have money to spend, have money to gamble, and
Hmm.
it clearly is also reflected in the stock market
Hmm.
as options betting is increasing. So
Hmm.
here's a quick dip on Zillow, I guess. So for some who may have not been aware, Zillow stock has been dropping since the start of the week because of their announcement that they're gonna pull back from their what do you call that? The iBuyer activity.
Hmm.
So their stock for the past 5 days alone has dropped 31% for the past week. For the past 6 months, it has lost 41%.
Hmm.
Since the start of the year, it has lost 49.8%, half their market cap or stock value. So this is a press release from Zillow CEO or co-founder Rich Barton, quote unquote. We've determined the unpredictability in forecasting home prices. Home prices far exceeds what we anticipated, and continuing to scale Zillow offers would result in too much earnings and balance sheet volatility. While we built and learned a tremendous amount operating Zillow offers, it served only a small portion of our customers. Our core business and brand are strong, and we remain committed to creating an integrated and digital real estate transaction that solves the pain points of buyers and sellers while serving a wider audience. So Zillow announced to that they're gonna wind down its Zillow offers,
Mm-hmm.
and they're actually gonna be cutting down their workforce by 25%.
Yes.
So that's a lot of employees being cut down. So Zillow offers, that's Zillow's main business actually. So if you're gonna look at their home segment, which breaks down into Zillow offers and other, I don't know what they even. So other segment is generated by rentals, new constructions, and display advertising.
Well,
So
well, if you're in the Dallas-Fort Worth area, you might get a bargain from Zillow. It's reported that they're selling more than 80% of their Dallas-Fort Worth area homes at a loss.
wow.
This is a report from Business Insider.
So there's a good
And
discount.
yeah, and the company is losing money on more than 60% of the houses it sells in its 5 largest metro markets,
Oh
according to
wow.
Business Insider.
So they're definitely taking a beating. A good amount of
Mhm.
losses on this one. So
But the buyers will benefit.
right, it's a good time.
Uh,
they're actually not like a. Would you say Huawei they're panic selling at this point in time?
um, I wouldn't say they're panic selling. I think they have to unload their inventory, just to balance their, uh, balance sheet, right? So they have to unload some of this inventory before they lose any more money. And I
Right.
think there will be buyers. People
Oh, the,
will.
mhm.
There's a lot of real estate investors right now that are looking for a bargain, and they will get it at Dallas Fort Worth.
Right. That'll be nice to get a nice place from Zillow. So
Mhm.
here's an article by CNBC that was published yesterday. Um, Zillow said in its third quarter earnings report on Tuesday that it was exiting the offers business after the company reported a pre tax loss of $422 million in its home segment. CEO Rich Barton told offers was ultimately too risky, too volatile to our earnings and operations, and had too low of a return on equity opportunity. Wow. So you're probably gonna be losing a good amount of money on this one because that's their bread and butter, is it? Right? Because if you look at their business segments, Zillow offers constitutes at least 99% of their revenue. So I
Mhm.
wonder where they're gonna be getting most of their business moving forward. Like a cut from realtor who sells the houses, that won't generate much money. So this is a very unusual step, but maybe I don't know. As you would say it, it's not like panic selling, I would say, but it's definitely a threat to its business.
Yeah, I think it's they uh, they just had too much money,
Mhm.
and they wanted to put it into these houses. Um, they don't know what to do with their money, and now they're stuck with all these homes that they need to get rid of.
Yeah. So here's a quote from Barton, the CEO and co-founder, during the conference call. I said, quote unquote, what it boils down to is our inability to have confidence in pricing in the future, enough confidence to put our own capital at risk. So they already did that actually.
They
So
Yeah, they paid too much. They
right.
paid too much to these homes and spent a lot for the repair and renovation.
Mm. So the iBuying process, this is the one that they're shutting down, allows homeowners to sell on Zillow instantly for cash rather than going through a broker and dealing with an extended bidding and closing process. After purchasing a home, Zillow would invest in repairs and maintenance, and even when factoring it in all those costs, try to sell at a profit. When the labor market tightened, supply chain bottlenecks sent costs for supply soaring. Zillow's already thin margins melted away. Add to that a housing market that flattened out or stopped increasing at the rate Zillow expected, and the company found itself drowning in a pool of underwater assets. So they're selling 7,000 houses, right?
Yeah, well, I don't know exactly the number,
Oh, I
but
think I have
but
a article coming up. Yeah,
but at the Dallas Fort Worth area, it says the second quarter they had about 2,000 home flips.
2,000. Whoa.
They were not expecting, the construction materials, the labor to go up, right?
Right.
I think that's what happened. They didn't know that that would be a factor.
Yeah. Yeah. So this is it. Zillow to sell 7,000 homes for 2.8 billion after flipping flop. So the Zestimate, I wonder if the Zestimate part of the Zillow, is that all inaccurate? More likely, yes, right? Because they're definitely defining it at this point in time that they're unsure or they're actually unable to determine the future value of a house.
Mhm. Until it sells.
Right. Because somebody has to buy it. And if you're selling it at too high of a price, and that's interesting because people still want to buy a home at this point in time. People are still looking homes. There's not much a big of a dip. Well, correct. I want to correct that because I think I saw, in terms of a real estate, the vehicle purchase sentiment, and the real estate sentiment. It has slowly died down back in September, as I remember it.
Mhm.
So definitely, this kind of affected probably one of their algorithms, indicating for them to get out now, as early as now, in order to not suffer more losses in the near future.
Yeah.
So here's one. Cathie Wood actually bought some Zillow and then dumped it the following day.
Hmm.
Cathie Wood and her flagship exchange traded fund Arc Innovation made an about face move on Wednesday and dumped over 2.85 million shares of Zillow, according to daily records. The move comes after Tuesday's purchase of 288,000 shares of Zillow. So they bought a little bit, but they sold a bunch of it. Wood and her team looked to purchase the dip as the stock price dropped more than 9% on Tuesday, but Wednesday, the stock plummeted 25%. The drop in Zillow proved too much for Wood as ARK liquidated a sizable chunk. Zillow has now fallen 36% in the last 3 trading sessions. Phew. That's a quick turnabout. So here's an interview by CNBC of Zillow. Let's roll this clip. Oh, if only it would play. Oh, there we go. Slight delay. Sorry about the delay, guys. I should have opened this on YouTube. It will be faster.
Mhm. Yeah, I'm just reading the statement regarding Zillow.
Oh, sorry. Here we go.
Yeah.
So let's talk about
Yeah, let's listen to
entering
this.
the Zillow Homes business and the home flipping, as we just described it as. Is this a sort of full-scale admission that you should never have gone into that business line in the first place?
It was a really tough but necessary decision, Wilfred. And I guess first and foremost, the decision to wind down our Zillow Offers iBuying operation involves a layoff of about 25% of the workforce. And that is a heavy, heavy thing given all of the people involved and all of the work they've put in. And we're committed to a smooth transition there. So I just wanted to say that up front, but this was a necessary decision. We just determined that being an iBuyer was too risky, too volatile, and ultimately addressed too few customers, too narrow.
So I mean, I guess some could have suggested to you before you did it that it's going to be volatile and unpredictable, and obviously changed the sort of predictability of your earnings flow. So to what extent was this a sort of "I told you so" moment to some people that said that in the first place?
I'm sure there are those that told me that. And I'm sure there are those out there wagging their fingers at me right now, justified. We went into the business as a big swing on the bet that we could actually predict the price of a home 6 months into the future and do so with a very narrow margin of error and have our hold times be very short. And what's happened is COVID happened. We've had a global pandemic. We've had a housing market that froze up initially. And now we've seen a growth rate, an acceleration rate in the housing market that we've never before witnessed in history. And as you might imagine, that has made predicting the price of a home 6 months into the future really difficult. And we're doing it at a scale that is 1/10 what it needs to be in order to get to the scale we think we need to achieve to offer good prices. So we stepped back, we assessed, we looked at the volatility in our earnings that we're reporting today, and we said, hey, we don't need to be doing this. We sit in a privileged spot in a mover's decision-making process. We get a good look at all of these movers, and we now have a whole bunch of tools that we can get them to move in a more asset-light way.
So as a result, so Bloomberg's reporting today that you have 7,000 homes to sell for $2.8 billion and that you're pitching it to all sorts of institutional investors. Can you confirm that? And separately, a KeyBank analyst said most of those homes are underwater.
Well, we have always sold the homes that we've had in inventory in all ways, including the regular market and including to these kinds of buyers. We've always done that. And we are not, I will tell you, we're not in any kind of a fire sale move. We're not in a big hurry to sell these homes. We're going to do it in an orderly fashion. These are appreciating homes. They are real assets, and we will wind down our inventory in an orderly way. We are in a big hurry. What we are in a big hurry to do is get them ready to be sold, to get them closed, to get them renovated, and to get them back on the market.
All right.
Yeah, so they're unloading a lot of real estate. I was just watching an interview on TV, and they were interviewing this Brazilian billionaire, Carlos Vaz, who's investing in multifamily real estate in Dallas. And that was his job. His job was to renovate, flip homes. And as he was scaling up and his business was growing, he realized that, it's hard to scale when you're having to flip homes.
It's hard, right? Because you have to make sure your margin of error and margin in terms of you being able to sell at a higher price, it's still intact after all the repairs are accounted for.
And the time factor,
Yeah.
how quickly can you flip, and you just never know. But it just reminded me of that interview with him. But now he's focusing more on low cost housing, apartments and stuff like that. And I think there's more value in that.
Okay. Yeah, that makes sense. I think with more units in one address, catering to different people which are accustomed to renting out and not buying houses, then you will probably end up getting a stable cash flow eventually. So this article, Wawi, you shared this one to the group yesterday, which is very timely. It's entitled "Housing Analyst Famous for Pre-Crash Warnings is Concerned Again." It was published yesterday, as you've shared it, very timely. Byline says, Zelman says market is at or near peak with corrections coming. Price gains are unsustainable, inflated by investors, she says. So this is definitely a big warning for us real estate investors out there. So what do you think of this, Wawi?
Well, that's called a price correction.
So maybe go ahead.
We had like a 20% increase in home prices, and now we're gonna get the true value by next year.
Yeah.
So those are patient and patiently waiting to find good prices to buy their first home, they may get a chance next year.
Right. We've always been reviewing the Redfin numbers that they release on a weekly basis and also on a monthly basis. And yep, definitely 20 to 25% in price increase since last year. And I just watched a video by Meet Kevin. He's a real estate guy and tried to run for he actually ran for governor there in California. He said for every 1% rise in treasury yields or probably mortgage rate, if 1% rise in mortgage rates, that would indicate a drop of 10% in house price. So I don't know how accurate is that. So that's something also to keep an eye on.
Well, that agrees with what Zellman is saying in this article.
Mm-hmm.
She's saying that if it reaches, like 4% on that interest rate, then we'll see a massive correction.
Right. So here's what she said, quote unquote, if I'm a home buyer right now, I want to wait because I think we've gotten to a level that's not sustainable. It's quite interesting. We're faced with the worst. So these are like give and go, like questions and being answered by her. So it says here, Bloomberg asked her, we're faced with the worst housing shortage in history. How could that possibly change? She said, we don't believe we're in a shortage, so our view is different than the market's perception. We've been more concerned about the level of growth in household formations in the US. Actually, this past decade, it grew at the slowest pace on record. So supply has not been meeting the demand to begin with.
But home builders are doing pretty good. I'm gonna look at my watch list real quick because
here you go. Here's a question about the rates and affordability. So Bloomberg questioned, would the jump in rates do more than depress affordability? Would it dissuade homeowners with low rates from trading up? So she said, the terrible Fed policy of continuing to purchase mortgage-backed securities at $40 billion a month has kept rates at artificially low levels. The backlash of that is it's going to impact mobility, because when you look at the number of homeowners that are locked in, not at 4%, but below 4%, we are talking almost 70% of mortgage holders. Yes. Right now, the benefit of the arbitrage is still there. If you can buy a home and get a rate lower than where you were locked in at, and you have a higher home price that you would have to digest, that's offset by the lower rate. If you have a higher home prices plus higher rates, it just disincentivizes mobility. So it would definitely affect the work from home, I think, the mobility part. Like you can go buy a house anywhere you want and stay there because there's a low rate, and you can purchase a higher price home because of low rates. So if there's a higher rates and the prices don't immediately subside, then there's no incentive for you to do such a move. So that's what she's pointing out. So it greatly disincentivizes mobility. Hard word to pronounce. So are we heading for a crash? There are going to be corrections, and I think there are going to be corrections that are more pronounced if rates go higher. I certainly would be concerned if I was buying a home today in, let's say, the Phoenix tertiary market in a higher rate environment. All right, really interesting. All right, so now we're at our roll the clip segments. Before we proceed, Wawi, do you have anything to share regarding the home prices? Or I think Wawi cut out there for a second. Hopefully we get him back soon. So we're gonna go ahead with a roll the clip segment. So this is an interview from one of Wells Fargo's analysts entitled Wells Fargo's Hand Sees Market Cycle Shift as Fed Hikes. So this was on November 2nd with 6,400 views.
And let's talk about 48.25 year end on the S&P 500, 48.25 and then something closer to 4,700 next year. Just frame the view at Wells with your buddy Chris Harvey for us.
Well, I think for this year, and what's really given us confidence into our price target for the next 2 months, look at how 3Q earnings have been coming in. As much as all we hear about is supply chain issues, labor costs going up, labor shortages, really, what we're seeing is that margins have been growing overall for the S&P 500 companies. That's telling us that this earnings growth has been robust. And it's partly because, like you guys were talking about before, that demand has been rather inelastic. Demand has been booming. And it's helping us and our prospects going into year end. But like you said, now for next year, for 2022, we're going to see tapering start to finish probably around mid-year. Then you're starting to see rumors about that rate hike being priced in. And that's the kind of environment where we're shifting from this more mid-cycle to late cycle.
So Anna, your SPX calls down 37,500-ish, who knows, and maybe we'll overshoot to SPX 5,000, which would be remarkable. On the way up, adults are going to come to you and say, we must hedge this great bull market. And yet with this convexity, this acceleration, hedges become so expensive. Is that where we are now, that you can't intelligently hedge a great bull market?
Well, as the pace has been accelerating, what's been interesting is you look at the volatility markets and you're seeing that implied over realized is actually not too expensive right now. I think a lot of that's been brought down by the additional confidence in earnings growth and just sort of the better outlook and clarity we're getting. So in fact, hedges, I don't think hedges are that expensive here. I think it's possible. You just got to pick your time frame.
And this is, Lisa, this is absolutely critical, and it's an indication that this is not cathartic. You're not getting the emotion as indicated by expensive hedges where you go, I can't take part.
And part of this is, how do you bet against a market that seems by some maybe would call Teflon-like in its appearance in terms of rallying? Honestly, and I do wonder how much this hinges on this idea that there still is so much liquidity in the market based on where the Fed is in their policy, that even if they become a little more hawkish, if they start to taper their bond purchases, you still have negative real yields of around negative 1% on the 10-year yield in the United States. How much is this driving everything at this point, regardless of fundamentals, regardless of what story you tell in the economic cycle?
No, Lisa, you're absolutely calling out that big elephant in the room. Even if we start tapering, these purchases are massive. This is the most monetary liquidity we've had in quite some time. And don't forget, we've had a lot of fiscal stimulus down the pipeline as well, perhaps more coming. So in that kind of environment, it's helping people and it's giving us that flexibility.
Hey, naputol.
And to move markets
Welcome
around.
back, Kuya Wawi.
Yeah, got an
still-
interruption.
We're still recording.
Yields are still coming off of very, very low levels, and credit, while it's riding off tights, it's still historically low. So all that context, it's a great point. I think that's a lot of the reason why I'm enjoying the sort of boost we're seeing now.
Anna, just give me a second. This could be one of the biggest contrarian indicators we've had in quite a while. Lisa, are you sounding a little bit bullish?
No.
Are you sure?
I mean, what is bullish?
Tom, would you go there? Did it start to sound like that, Tom?
In theory, what is bullish?
Well, thank you.
What's going on?
Honestly,
And you got to combine that in with a careful Gina Martin Adams, Anna Hahn kind of analysis.
Just to confirm, Lisa is not bullish based on what Lisa just said. Are we done with that now, Lisa? That flirtation with
I'm
that
not bullish
constructive
or
view?
bearish.
You're not?
I'm trying to look around corners that
Of
have
course,
negative
of
things
course.
there, because
Thank you
that's
for
what the
clarifying.
corners are that are concerning.
Thanks for clarifying.
Anytime.
And a final question. How big is the Fed's involvement in this equity market?
It is undeniably large. And if anything, the Fed has made sure to communicate their stance because they know the impact on the equity market. And, to Lisa's point, there is going to be one sector we're looking at in particular, the favorite, tech, that is going to be having a harder time if real yields start to take off. And I think real yields will start to move higher away from these negative
But Anna, they haven't yet. That's a fact, right?
Mm-hmm. Yeah, what's been interesting is as we are getting this consensus on tapering, you would expect real yields to really start picking up. They've been going a little bit the other way lately, and that's what's giving us pause. Talk about looking around the corner. That's a little point of the market that we're wondering, is it signaling something different to us? But I think you need to give it time. We're looking on this day-to-day framework. We need to think in months and quarters ahead.
Okay, so tech is definitely something to look at once we start experiencing the rate hikes. which she was already looking at. Probably just have to give more time.
Well, two factors there to consider will be, the number of new investors, retail investors that are, they're inexperienced with the
Mhm.
market and highly speculative. So I'm seeing more volatility. That's
Right.
that's gonna be the new normal, Mark. I think.
More volatile state.
Yeah.
Mhm.
So this will be a more volatile market, in my opinion, coming next year
Yeah.
as we taper down.
Yeah, for sure. Because right now we're at lows like 15 points and past months that we have reviewed earlier. So another interview by Bloomberg here on November 2nd entitled "Market Priced in Too Many Rate Hikes." Morgan Stanley's Caron, almost 5,600 views. Let's roll the clip.
For rate hikes next year, is that in line with your view of how this is going to play out at the Fed?
Well, first of all, thank you for having me be leadoff batter today on your show. Look, I think the narrative on inflation is a little bit confused. We're talking about what inflation is today, and we know today it's high. Core PCE is high. We know it's going to probably be high in the first quarter, but what we're not talking about is where inflation is going to be in the second quarter, in the third quarter, and in the fourth quarter. The Fed needs to look forward, and the Fed will look forward. So I think the rate hikes are probably that are being priced over 2 rate hikes as Lisa was just discussing. I think is too many. I think it could be 2, but the point here is that inflation is expected to fall off dramatically starting in the second quarter of next year because the year-over-year base effects are going to be very, very difficult to beat. And in the third quarter of next year, and even in the fourth quarter of next year, inflation might be just over 2% on a core PCE measure. So to think that the Fed is going to be hiking rates aggressively into declining inflation, or what may be likely declining inflation, I think is a little bit of a stretch in terms of what the market is pricing at this point.
Jim, the zeitgeist, and I'm going to give credit to George Saravelis of Deutsche Bank off their foreign exchange desk, is a shift here, a subtle shift from transitory over to macro blather and all the Fed talk and that, over to VAR reality where people are losing money on bets placed previously. Is that what we're seeing?
We are seeing some of that. So there were a lot of curve steepeners that were in the market prior to the big flattening that we saw, and that certainly contributed to it. So I wouldn't cast that aside as nothing. I think that there has been a pretty big shift. And look, central banks have marked themselves to markets. They've become a lot more hawkish in terms of their overall tone. So I think the technicals did play a big factor, Tom.
Right now, we're taking a look at people bringing forward the number of rate hikes that the Federal Reserve will actually execute, not just the timing. And this is a shift. I wonder if this is accurately baked into the rest of the bond market, or if this is just sort of peripheral calls that are trading and not actually bets on the future.
So Lisa, I love your question. If the yield curve is talking, then is anybody listening? And the problem is that not that many other markets are listening, right? So what the yield curve is basically saying is that the Fed's going to bring, or central banks are going to bring rate hikes forward. The curve is going to flatten because the market is not willing to adjust higher the terminal Fed funds rate or the terminal central bank rate. So that means that we're still in a low rate environment from a Fed policy perspective, but we may bring some of these rate hikes forward. So what's happening in high yield spreads? Almost nothing. What's happening in investment grade spreads? Almost nothing. What's happening to equities? Equities are making new highs. So we could say that, well, maybe these markets have it wrong somewhat at this point. But as far as I can say, if the yield curve falls in the woods, is anybody listening? And the yield curve has been falling and nobody else has been listening. And I think this is a very, very critical message in and of itself. This is information too. When you bring rate hikes forward because we're responding to supply shocks that today has inflation higher, doesn't mean that inflation will necessarily be higher and continue to grow. Remember, inflation is the growth rate of prices. We may not be having this at this time next year. So therefore, the market's unwilling to raise the terminal Fed funds rate or the terminal central bank rate. Yeah. So therefore, long end yields, intermediate term yields, or mainly 10-year yields aren't really changing all that much. And 30-year long bond yields have actually been falling. So it is pretty curious right now.
Jim, what do you do then as an investor with this? I mean, basically, do you bet that the market is wrong, and do you sell high yield debt? Do you sell riskier assets?
Yeah, so the answer is not us at Morgan Stanley Investment Management. We still like high yield, because the point is that the central bank is going to raise rates, but they're not trying to tighten financial conditions. They still want to keep financial conditions easy, to expand the economic cycle, to continue with growth, to continue to push down the unemployment rate. It's a broad, inclusive goal for the Fed to get all demographics to participate in this expansion. And I think that's exactly what's taking place here. So the Fed is not trying to kill the expansion. They're trying to extend it, but they may have to address the near-term pressures of inflation with a rate hike or two. And that could be in 2022, but it doesn't mean that they're shifting their terminal rate a lot higher. And if they do, the terminal rate's 2.5%, by the way, is based on the Fed forecast. If the terminal rate goes from 2.5% to 3%, based on our calculations, the 10-year yield would be somewhere around 2.15%. We're not expecting that anytime soon, but the point here is that the terminal rate matters a lot, and the market is not willing to shift higher to longer-term rate hikes.
Whoa. So we might be actually being supported as well as Fed tapers. That's a very good interview right there, Bobby. It looks like despite the Fed is tapering down and possibly hiking their rates, it may actually be supportive of the market, because the Fed is actually not trying to, hinder economy activity, but they're just trying to address what's happening in the inflation part. Oh.
So added safety to us investors.
Right. It kind of like, after that interview, kind of might make me a little less bearish overall, despite the increasing amount of people getting more bullish. So last interview for this week's episode, we're going back to Mike Wilson of Morgan Stanley. We've been following this guy wherever he goes, CNBC, Bloomberg, or wherever, Fox. We play his interview because he's very insightful. So this happened November 1st with 23,000 views, entitled Morgan Stanley's Mike Wilson sees growing odds of a 10% to 20% correction this quarter. He's back at it again. The correction is coming soon.
Warns the market's record momentum could stall. Around Thanksgiving, Mike Wilson is Morgan Stanley's chief U.S. equity strategist and chief investment officer. Mike, it's always great to speak with you. Your note, fire and ice, we're entering the icy period. So what sparks that?
Yeah, I mean, look, this is a difficult time. We've had this fire and ice narrative now for really a couple of months, and the fire part is played out. Everybody's focused on the Fed this week, as it should be. I mean, this is a big change, or they've telegraphed it well. And look, part of the sell-off in September, we think, was directly a result of the Fed, talking more hawkishly, right? Rates went up and multiples came down, and we got a whopping 7% correction. And we backed off on the ICE portion kind of at the beginning of October, because the market stabilized, and we do a lot of work looking at flows like everybody, and we noticed that the retail community is just been coming in with a vengeance and continues to come in with cash, and it was again today. So that's a seasonal feature, we think, because institutional managers will also want to stay fully invested through this through the holiday period, the Santa Claus rally, as you call it. And we think that could last all the way till the year, and we do. It might last till Thanksgiving, we don't know. But what I want to make clear today, and we've tried to make clear in our notes, is the ICE portion of our narrative has not played out yet. So we just have a different view than most people. We don't think growth is going to re-accelerate, into the first part of next year, particularly for earnings, for a lot of the reasons you all were just talking about. One is supply chain issues and costs. Some companies are missing sales outright because they can't even get the supply. That's another problem. But we think there's actually inherently a demand problem ultimately as well. There is going to be a bit of a fiscal cliff no matter what happens in Washington, just on a comparative basis to next year. And we just got to work through all that. All right. So it's not the end of the world. Expectations are pretty lofty. Valuations are really stretched right now. And so we think that ICE portion is going to play through into the first quarter. And look, it's always about picking the right stocks and sectors anyways for us. I mean, that's what we try to do. And right now, we would say you want to lean a little bit more defensively, things like healthcare, which is cheaper growth. Some parts of technology still look fine to us, but not the whole bucket. And then financials should work into the end of the year if rates go up with the Fed's move this week.
Right. I think anybody who puts forth sort of a more bearish thesis in the markets, Mike, gets the pushback of the consumer is in great shape. The consumer has saved up a lot of money, ready to spend. There's going to be spending unleashed. The chart in your note over the weekend was fascinating to me, showing where personal savings are right now, back to pre-pandemic.
Yeah, it's a little known fact, I guess. But I mean, look, there are two things going on. First of all, we had incredible stimulus in the last year, and that did help spending. We know that. Everybody knows that consumer goods, we probably overconsume there. That's one area we definitely want to try to avoid. Consumer services may benefit as we transition to the reopening for the fourth time and people spend more on services. I think that will happen. But ultimately, you know, it's about how much money does the consumer have to kind of keep at this rate. They have been spending at an above trend rate when you combine the two. And we do think personal savings now are back below where, pre-COVID levels. And the data shows that. Where we could see an offset is with the wealth effect. Okay, so that chart that you cited does not include things like stocks and real estate and maybe cryptocurrency assets. And that's a big positive. One thing I would say is that money is pretty concentrated, probably in the upper quartile of the population. And those folks, you know, they're probably not going to spend it as much as somebody in the lower end cohort where there's a high propensity to spend. So that's the setup. I mean, I think we get a strong holiday spending season because of that wealth effect. But I think after that, then you have a risk of a real surprise in the downside from a demand standpoint as those stimulus checks and things that we did this year wear off.
Hey, Mike, it's Caron. Thanks so much for being on. I always love hearing what you have to say. I'm wondering on your thoughts about maybe Thanksgiving or end of the year is kind of the end of that bull run. Is there something sort of structural that would change the tone that would, you know, make people more bearish?
No, I don't think there's anything, I don't think there's a single smoking gun. I think there's a bunch of things that you could say that line up. And I think a lot of folks are surprised that we're trading here, but nobody wants to fight the momentum. So it's really that simple, Caron. I think the price momentum, if it starts to fade, I think you'll see more supply. And the structural thing I would say is more seasonal, right? And, typically as you go into a new year, the clock starts again, particularly for asset managers. And, they may decide, okay, this is a time where I do want to take some risk off because I see the same thing that maybe I'm talking about. And a lot of clients we speak to are saying that, but they just don't want to abandon ship too early. So that's the structural part. It's a seasonal dynamic, and that lends itself to kind of a tougher Q1.
Mike, always great to see you. Thanks so much.
All right. What do you think, Huawei?
Well, I'm just, remembering what Mark Glenn said, right?
Mm-hmm.
At the end of the year, people will try to do some tax loss harvesting and sell some of their investments at the end of the year to limit some of their tax obligations, right? Repercussions. So he's seeing that the consumer spending may not be there next year. It will be here for the holidays. So based on a lot of savings that the consumers have.
It has been pulled forward because of the stimmy checks.
Yes, and he's seeing that by next year it's really questionable, and seeing a 10 to 20% correction. So he's sticking to what he said last week.
A fire and ice.
Yeah, but okay. So what I'm seeing is like we have all this goods that's stuck in ports. Are they gonna reach the consumers this year, or are we gonna have an oversupply next year? Who's gonna take advantage of the oversupply next year of these consumer goods? Are people gonna overspend this year?
Right. Because
I don't know.
That's why he's staying away from consumer discretionary, but he's moving into healthcare and financials, which would usually do good in a certain environment as well as rising rates. So that's why he picked financials. Interesting, he never mentioned energy of the ever growing oil demand. So yeah, I guess that kind of sums it up. We are definitely not sure what's going to happen in the near future, but it's better to be aware of what's happening right now and what the experts are thinking about what the next best step is. So well, Huawei, I think that does it for now. Do you have any quotes of the week to share to our listeners?
No, I really don't. I have what the phenomenon of Robinhood.
Uh-huh.
I just wanted to share this with the listeners.
Sure, go ahead.
Just know, in Robinhood, that the customers are the product.
Customers themselves are the product. Okay.
Yeah, they are the product of Robinhood. Okay.
Because they do payment for order, right? Or order flow or something like that.
Yes.
They bulk it up and sell to big investment firms who process the orders or something and takes a cut from it or commission. Interesting. So we've learned a lot so far during this busy week. And I guess, well, Wawi, thank you so much for coming on this Thursday evening. It's already 8:34 p.m. We've been here for at least almost a couple of hours. If you're still with us, please don't hesitate to subscribe and hit the like button. We appreciate you for listening. Well, listeners, that does it for this episode of Marky and Wawi Show. Send your questions. If you just want to say hi, send us an email at markywawishow@gmail.com. Remember, build that emergency savings and invest the rest for an abundant retirement. This is Mark Yu signing out.
Wawi Santos was signing out.